Crowding out. Crowding out refers to the phenomenon where increased government spending and borrowing can reduce private sector investment. Understanding this concept is crucial for comprehending the intricate relationship between government actions and the overall economy. Before we delve into the implications, let's first define crowding out and provide an overview of its mechanics. Crowding out occurs when government spending and borrowing compete for resources within the economy, potentially leading to higher interest rates. This can have consequences for private investment and economic activity. Crowding out is best described as a situation where increased government spending diverts resources away from the private sector. This can reduce the availability of funds and diminish private investment opportunities. Additionally, government projects and programs may absorb resources that would have otherwise been utilized by the private sector. When the government increases its spending, it can have a direct impact on the availability of resources for private investment. As more resources are allocated towards government projects, there is less available for businesses to invest in their own growth and development. This reduction in private investment can have implications for long-term economic expansion. Another critical aspect of crowding out is the relationship between government borrowing and interest rates. When the government borrows extensively, it increases the demand for funds within the economy. This heightened demand can drive up interest rates, making it more expensive for businesses and individuals to borrow money. Higher interest rates, in turn, can discourage private sector investment and dampen economic activity. Crowding out can have adverse effects on overall economic growth and productivity. When private investment is crowded out by government spending, it can hinder long-term economic expansion. Private sector investment is often a catalyst for innovation, research and development, and technological advancements, all of which contribute to sustained economic growth. Private investment plays a significant role in job creation and employment opportunities. When crowding out occurs, and private investment is curtailed, it can have a direct impact on the labor market. Reduced investment means fewer resources available for businesses to expand their operations and hire new employees, potentially leading to slower job growth and increased unemployment. The concept of crowding out sparks ongoing policy debates and differing perspectives. Economists, policymakers, and experts hold varying opinions on the extent and significance of crowding out effects. These debates shape discussions surrounding the appropriate role of government spending, fiscal policy decisions, and the potential trade-offs between government involvement and private sector dynamics. Let's examine a historical case to better grasp practical implications of crowding out. In the 1980s, the United States implemented a significant increase in defense spending, driven by the Cold War tensions and the need to modernize its military capabilities. As the government allocated more funds towards defense expenditures, it faced the challenge of financing this increased spending. To cover the budget deficits resulting from higher defense spending, the government had to borrow from financial markets by issuing treasury bonds. This surge in government borrowing competed for funds with the private sector, leading to higher interest rates. As interest rates rose, businesses and individuals faced increased borrowing costs, which affected their investment and consumption decisions. The higher interest rates resulting from the government's borrowing to fund defense spending had the potential to crowd out private sector investment. Businesses may have faced difficulties accessing affordable credit, constraining their ability to expand, invest in new projects, or hire more workers. This historical example illustrates how crowding out can occur when increased government borrowing to finance specific sectors, such as defense, can lead to higher interest rates and reduced private sector investment, potentially impacting overall economic growth. Looking back at historical events or policies can provide insights into the impact of crowding out. Examples such as specific government initiatives, large-scale infrastructure projects, or wartime spending can shed light on the consequences these actions had on private investment, interest rates, and economic outcomes. Crowding out remains a relevant topic in today's economic landscape. Current examples or situations, such as government response to economic crises, substantial public debt, or government-funded programs, highlight the ongoing relevance of crowding out effects. Analyzing these cases helps us understand how crowding out can shape economic dynamics and influence policy decisions. And that wraps up our exploration of crowding out in today's video. If you enjoyed this video and found value in its content, We kindly ask you to support our channel. Remember to subscribe to stay updated with future videos, hit the bell icon to receive notifications, and leave a comment to share your thoughts and engage in meaningful discussions. Thank you and see you soon.